What's up, everyone? Hey, it's Clint Coons here. And in this segment, what I wanted to talk about was lending, because we know how difficult it is many times when market or interest rates go up. And if you're an investor and you're struggling trying to figure out how to put that deal together and where that money is going to come from, well, that can be a problem, hold us back with our real estate investing. So, what I thought I would do with this episode is bring on someone who is an expert in their field that has been in the lending business and knows how to work with investors. So I reached out to someone who we actually use here at Anderson. We make them available. They're one of our preferred providers when it comes to lending, and we recommend that our investor clients check out their products and work with them as far as putting their deals together. And that person that I'm bringing on right now is Rick Floyd, the Executive Vice President of Home Bridge Financial Services. Rick, you here?
Yep, I am Clint. It's glad to be with you today. Thank you.
Thanks for coming on. Owning a lending company and starting all that up, it's got to be kind of interesting. So, could you tell us a little bit of background on how you got to where you're at?
Yeah, absolutely. It's a pleasure to be here. Home Bridge Financial Services today. We're an independent mortgage lender. We employ about 2,400 associates across the country, and we actually formed Home Bridge, call it back in 2009, right after the real estate mortgage meltdown, because we felt like it was a golden opportunity to continue to fulfill the American dream. And so we put it together in 2009, and been very fortunate to grow through the years. And so I've been in this mortgage space for about 29 years now.
Great. So, you have quite a bit of experience, which is phenomenal because I'm going to be asking you some questions that I get all the time from my viewers and listeners about financing. It's a really, I would say it's a hot topic because for many people, you don't have tons of cash, you're going to have to borrow money, and setting yourself up the right way, knowing what you need to be doing before you go in to apply for that loan is so important. And also knowing the products, as you and I have discussed prior to us coming on this episode. So, just to start off with, when it comes to lending, if I was going to walk in, and I'm a real estate investor and I'm going through the traditional route, we'll talk about non QM here in a little bit. You know, most loans, right, for real estate investors, they're going to be underwritten with Freddie Fannie guidelines. Is that pretty consistent?
Yep, that is correct, and especially in the agency space. So it'll be your typical, Fannie Freddie, guidelines, unless it's in the jumbo world, which also those dollar amounts differ by state, across the country.
Okay. So if I came in and I apply for that loan, one of the things that I tell people is that if you have existing rental properties, that depending on where they hit your tax return, Freddie Fannie will force you to hold back a certain amount of income.
Yeah, obviously, there's lots of different, there's, what's the right word I'm looking for? Quirk, quirk probably not the right word, but different, components of their guidelines. So if you currently have a portfolio of investment properties, obviously, you're limited to the number that you can finance, as you and I talked about earlier. And
Mhm.
then, but also there's different caveats to how much income you can show, whether you're a W-2 or you're self-employed. But again, it's just such a key to make sure, to your point, Clint, that you got all your ducks lined up in a row and you clearly understand, and if you're, no matter which lender you go to, you need to make sure you use somebody that clearly, looks at your whole picture, not what you're just trying to do now, but what you're looking to do in the future as well, so that those deals can be structured, not just for now, but your goals and what you're looking to do down the road, where you're looking to sell some, buy more, and so forth. But there's lots of different guidelines inside of the Fannie and Freddie world.
Okay, so if I was going to come in and I was going to be using a traditional broker and go through that standard process where it's Freddie Fannie, what are some of the common mistakes that you see real estate investors make when they're applying for a loan?
Um, Probably some of the biggest mistakes would obviously, you got to know, how you're looking to structure it and what terms, you're basically looking for. But I would say some of the pitfalls to stay away from is to talk through with your lender what you're looking to do first before you apply, right? And let he or she guide you, as to not that you're not going to disclose everything and be forthright, but they can talk you through to make sure that that's truly the route you need to go, right? Because in today's environment, we had pre-COVID, then we had all the guidelines that were tight during COVID. And some of those still exist, even though a lot of them have been relinquished, especially in the self-employed arena. So it's just a key to make sure that you talk through. And again, I know I'm repeating that, what's the route you want to go? Because the Fannie and Freddie and the agency route may not be the route that you want to go, because there's plenty other options for you today. But if you've got, cash on hand, you got good LTV, good FICO scores, obviously, your Fannie Freddie, is the route to go if you meet all those components, because your interest rates will be lower, going that route. They've also added on, this is more on the second home, which I know we're talking about investors here, but Fannie and Freddie have both added a lot of add-ons to the second home arena. So you just got to be careful to watch, make sure you ask your lender, what are add-ons for the different types of investment properties and so forth.
So when you're going into or setting yourself up before you apply for a loan, how important on the investment side is seasoning of cash to buy or for that down payment for qualifying?
Seasoning, Clint, is not as important as being able to validate where that cash came from, right? Okay. If it's new cash, right? If it's been sitting in your accounts for a lengthy period of time, not an issue. But if you've just moved $100,000 into this bank account or that, we have a lot of our clients that are looking to buy properties that are taking out HELOCs on their existing primary residence in order to help cash flow investment properties that they're buying as well. So it's not critical that it has to sit there for a period of time. You just have to be able to source it.
You got to be able to source it. So showing them that where it came from is what's important. A lot of our clients will set up limited liability companies. They'll have an LLC and they'll park all their cash in them. That's what I do. And then when I want to buy a property, I'll distribute the cash, transfer it from my LLC account into my personal account. And I've run into problems before with lenders where I hadn't anticipated finding this deal, and then they'll see that transfer of cash and they'll be like, wait a minute, where'd that come from? And they want to trace it all the way back up to the LLC. And if they see distributions coming into the LLC, they really start sniffing around and digging in my LLC going, well, where'd that money come from? And that money. And I have to explain to them, well, those are other businesses that I hold, and those are distributions.
Right. Well, again, each, as each lender can be a little different, right, in their interpretation of the rules that may not be just clearly, black and white. I would just tell you at Home Bridge, just because we do a lot of variations of different type of businesses and deal with all types of walks of life. I can't say that issue wouldn't take place here, but as long as you can source it back, we're not going to dig, into, things that just to create questions, just to be asking questions.
Got it. Well, why does it seem like whenever you're using these traditional products, the Fannie, Freddie stuff, why are there so many hoops that I have to jump through to get these loans through? Is that because you're selling them?
Well, but that's because, most lenders sell the loans, right, to Fannie and Freddie, and or they put them into a security. So you've just got to make sure that, we in our lending business sometimes think that the agencies have become that dotting the I's and crossing the T's are more important than the quality of the, of the borrower. But then there's the differences whether you service your loans, like we do. It's not to say that we want to make bad loans to put in our servicing portfolio, but maybe every single I doesn't have to be dotted and T crossed when a lender, services and it creates their own portfolio of loans versus those that sell, direct to Fannie and Freddie.
So is that a question that someone should ask then if they're going in to work with someone? Is this going to be a portfolio loan, or are you going to
Yes,
sell it?
absolutely. Great question. Great point that I should have brought up a while ago. That's a great question to ask your lender. Yes.
And if, say, for instance, I came to you and I asked that question, you said, "Oh, we'll probably treat it as a portfolio loan." Um, would you then still use Freddie Fannie guidelines, or would you be
Yes.
more open to
No, we would
using?
still use Fannie Freddie guidelines, but again,
Okay,
if there's minor T's and I's dotted and crossed, that's where that comes into play. But we would still follow the agency guidelines, in case we decided to sell your loan at some point in time.
okay,
But it just gives you a little bit more flexibility, Clint. From all the from all the details that you don't necessarily have to follow.
got it. So what I'm hearing then is that even though you may treat it as a portfolio loan, you still want to keep your options open. That if you needed to sell that loan to Freddie or Fannie, it comports with their guidelines or underwriting guidelines, so they'll buy it. You won't have to separately negotiate it.
That is correct. Absolutely. You hit the nail right on the head. But look, if you've got a solid borrower, lots of cash, low LTVs, it gives you some flexibility.
Okay. All right. So I've often, told investors, hey, the Freddie Fannie route, I go, most people end up going that route because they don't know anything else or if there's any other ways to put deals together. And as you and I were talking about beforehand, the non-qualified mortgage route is another door that someone could walk through. So could you explain what a non-qualified mortgage is?
Yep, absolutely. Non-qualified mortgage is obviously, it's not an agency loan. And right. And so we do, the industry and at Home Bridge, we do a lot of non-QM because a lot of it fits because, they've got, you got a 12-month bank statement, you got a 24-month bank statement, you got investor cash flow. There's all types of loans. And basically these are loans that don't meet the Fannie Freddie guidelines. Right? And investors have an appetite for them, right? So if you're self-employed, you just got 12 months of bank statements. It's basically analyzing your cash flow, looking just from your wherewithal to make the payments. Obviously, your credit's examined as well, but that's a huge space, especially in the investor community, because we do a lot of that investor cash flow. So if you own 10 properties, instead of underwriting in your tax returns and so forth, we're underwriting the cash flow of those properties. So I would highly recommend that any of your clients that or either self-employed or don't have different structures, a lot of K1s or just different flows of cash in their businesses, to definitely talk to their lenders about the non-qualified mortgage, or also known as non-QM. Now your rates are going to be a little higher, but that's just because to offset the risk of not underwriting you to a fine tooth comb, so to speak. So it's a great product for your investors that are buying residential properties.
Okay, so let's break this down. So with the bank statements, what are you looking for there on the bank statements?
Cash flow, just make sure that you've got enough cash flow to sustain your debts, right? So again, so it's a 12-month, 24 months. So if you need 24 months to look at a bigger picture, obviously you get a lower break if you go longer and you can prove that you've got the cash flow. So if you've got $20,000 flowing in and out of your accounts each month, you can easily see that you've got the cash flow to make your payments, on your mortgage. And then the investor cash flow is obviously the properties.
So if an investor had limited liability companies set up and or land trusts, entities that we typically recommend and investors create for asset protection purposes, when you're looking at the bank account, would you just take the LLC's bank account and judge the cash flow if I can show you that I'm the owner of that LLC? Is that how that would work?
Yes, sir. That absolutely. LLCs are not a problem in the non-QM space. The LLC cash flows, limited liabilities.
All right, and then when you talk about the rental income, if you can show the income coming in, as we were talking about touching on the issues with the Freddie Fannie stuff where they have a holdback, my understanding 25, some I've seen 30% as far as rents will not be applied. for vacancy purposes. When you're going non-QM, do they do the same thing or do you get 100%?
100%. So on that investor cash flow, it's 100%.
Okay. So when we're doing that non-QM, then does it also allow me to close in a limited liability company?
Yes, yes. On the non-QM side, you can close in an LLC. That is correct.
And with those non-QMs, do I have to give a personal guarantee or are these asset-based loans?
And well, there are programs that are asset based, but these non-QMs are you're personally guaranteeing it, right? Because the property is your collateral, you're personally guaranteeing it as well. Now there are the asset, type loans. We don't do many of those here at Home Bridge, but they do exist in the marketplace.
Got it. Well, how important is my personal credit score then when I'm using a non-QM loan?
Always, always. Um, they will take a lower FICOs, but the hits to your pricing are pretty dramatic.
So the other thing too is, as you and I were discussing with Freddie Fannie, they allow each borrower to acquire 10 properties, and so I see this a lot. A husband and wife, they'll both go on a few of the loans together, and if they went on 4 loans, and they realize when I start talking to them, hey, you just took 4 potential opportunities away from yourself if you're going to stick working with the Freddie Fannie market, because each of you can only be on 10 loans total.
Correct.
Whereas with non-QM, is that even a consideration?
No, sir, not an issue. Yeah, those guidelines, that same 10 cap does not apply in the non-QM space.
Well, so in the non-QM space, then where's the money coming from?
A lot of investors. There's hedge funds that operate in the non-QM space. We at Homebridge, we pull 7 different investors. Whether it's like Goldman Sachs or Starwood or a lot of them, we pull those together, created our guidelines that they would all buy. And then obviously there's exceptions to that. We go to those guys for that. It's investors' money, it's hedge fund monies, just looking to get a return on their monies. Like Goldman Sachs is a big player, Angel Oak, Starwood, just different investors.
So can you give us an idea of what the typical terms are for a loan like this?
Yeah, in today's environment, Clint, you're in the high sevens.
Okay.
If you've got it depends. If you've got a low LTV and a high FICO score, you'll still be in the mid sixes.
Hmm.
But again, if if you're looking to finance at a high LTV or you got a lower, under a 700 FICO score, it's really going to get bumped up into the sevens. Most of the non-QM business in today's environment is in that low 7 to mid 7 range. But you're paying to have different options for your financing.
Got it. So with the terms of the loan, is it any different than the Freddie Fannie? Are there prepayment penalty clauses in there?
No, no, you still do 15, 20, 30. Yeah, there's no prepayment penalties. Some investors will write it with a prepayment penalty, but we do not. But they're your 15, 20, 25, 30-year terms with no prepayment penalties on ours. Obviously, some lenders may offer it.
So typically, how much do I need down on an investment loan then for this type of product?
If you want the best rate and so forth, you're probably needing at least 30% plus.
30%?
Yeah. You
How
don't
about if I
have
found a
to,
prop? Go ahead.
but if
Yep.
you don't have to, right? I mean, you could do it with as little as 10% down, but you're going to pay for the risk.
Because the interest rate's going to go up based upon the risk the lender is taking on, and that is
Absolutely.
dependent upon you as the borrower and how much money you're bringing to the table, what your credit score is, things like that.
That is correct. Yes, sir.
So here's what I'm wondering. Let's assume that I bought a property on contract with a seller. So
Okay.
the seller's carrying the note. And the deal is that in 3 years, I would finance that seller out. So I come to you and I say, listen, I got this property. I bought it for 150. It's now worth 200. And all I need to do is cash out the seller who's carrying the note against the property. Would that qualify under a non-QM type deal transaction?
So make sure I'm clear. So the seller is holding the note back. So you're buying it from John Doe, and John Doe is going to take back the lien. He's going to be your lien holder.
Correct.
And now you want to finance that property to pay off John Doe.
Yes.
It's a great question. I'm going to, with my experience, Clint, I'm going to say yes. That we could qualify that under the non-QM space.
And then that equity, so there's equity in that property. Do I need to come up with anything in a situation like that, or do they also count if I've negotiated a price for a piece of property, a house, and there's built-in equity, what it appraises at? Let's say it appraises for 25% higher than the purchase price. Would that count then towards my down, or do they still look for it saying, hey, even though you got equity, it's great, but we still want to see 20% down to get those lower rates?
That built-in equity there can be used for your down payment.
Great. So they could use that built-in equity, because I know investors have properties like that that they found, and if it's a cash flow issue, bring the property with the equity.
Yep, absolutely.
Okay. So HELOCs. Are you doing any on investment properties?
No, we're doing it today only on primary residence, not only any investment properties.
Why don't they do them on investment properties?
Just risk. That's not to say that some investors may not be out there. I can't speak for everybody out there. Today at Home Bridge, we only do them only on primary residence.
Okay. So if I had an investment property with, say, fair market value, $600,000, $400,000 in equity, so I owe $200 to Wells Fargo. If I came to you, could I do a cash out refi on that deal and maybe pull $250?
Absolutely. Yes.
Okay.
Yes, absolutely. Yeah, we do cash out refis on investment property all the time. We just don't do the HELOCs today on those.
So that's something then for the investor that can't get the HELOC and has a lot of equity in their rentals to keep expanding their portfolio. Best thing to do then would look at going that route to do cash out refis.
Yep, cash out refis, absolutely. And then you can do those on the non-QM side, the agency side, either whichever way the program best fits, their needs and their situation.
Are you finding most of your investor clients that are coming to you, are they mainly going non-QM now, or are they still on the agency side?
Yeah, most of them are going non-QM. Just because it's easier, with their, cash flows, just the guidelines and so forth. So they're paying a little bit higher for it, but it's just an easier process.
And what is the typical closing time, underwriting time for a non-QM versus an agency? Is it shorter?
Yeah, well, no, they're both. The time frames, in 2020, 2021, it's probably a little bit longer, than it is now, with volumes down as an industry. But, they're, 48, 72-hour tops, underwriting turn times.
With rising interest rates, where do you see everything going for the investor in the next year or so?
Yeah, that is a loaded question, right?
Mm-hmm.
The biggest, interest rates are what they are, right? I mean, interest rates not our biggest challenge today. Biggest challenge today is lack of inventory. And now rising rates, don't get me wrong, there's a big difference between 2 3/4 and 5 3/4. But we've all seen this roller coaster of interest rates. Lack of inventory is a big impediment to the environment today.
Yeah, you see, I was talking to an investor this morning, and he asked me the question. He goes, "Well, what do you think is going to happen with the market right now, with home prices, with rising interest rates? Are the prices going to, of course, possibly fall? Is it going to be something like we saw back in 2008?" And I had my views on it, but I'm curious what your views are.
Personally, obviously, Clint, we're fighting inflation, right? We're fighting,
Mm-hmm.
fighting 8.5 and inflation, depending on what the Fed wants to do. But my personal opinion is that we're going to see some stabilization in the short near future, and then we will not have a relive of 2007, 8, 9 during those times. And I don't think we're going to see, you know, I don't think we're going to see the values fall. Again, I'm not saying our firm belief is that they will plateau here, and I don't think we're going to continue to see people paying a couple $100,000 over asking price on a lot of this stuff. But we think rates will find a spot to settle in here, and that and they'll get everything under control. So, but do not see a 2008 on the horizon in our viewpoint. I don't know how what your thoughts are, but that's Rick Floyd's opinion.
Yeah, I agree. That's different metrics now than it was back then with the way they were going to write loans
and
job
lending.
market.
The problem is back then lending. If you had a pulse, we gave you a loan.
Yep.
We're trying to make it a little easier, but you still have some hurdles to go through, unlike in 08 and with the Alt-A type business.
There's one question I forgot to ask you on that non-QM side that I'm curious about, and that has to do with property transfer. So let's assume that we closed in a Texas LLC and you're holding the first position on that. If I decide I wanted to move it to a separate LLC, have you ever seen a lender? I mean, would you guys call that note due, or does that even matter at that point in time since you're secured against the property?
That doesn't. It doesn't. It wouldn't matter. So, as long as the payments continue to keep being made and so forth. I mean,
keep the property insured, pay the taxes, and
yes,
pay your
absolutely.
mortgage
Yeah. Check all the boxes, and then we would not care about if you transfer that to your LLCs and so forth. Not an issue on our front.
Well, Rick, it's been a pleasure speaking with you. What I'm going to do is I'm going to put the contact information for Home Bridge Financial in the show notes. So if anybody wants to reach out to you all to talk about a non-QM product for their investing, hopefully it'll drive up some business for you and allow some investors to get into some properties.
Absolutely. And applaud you for the services that you offer to your clients. And we greatly appreciate the time, and any questions along the way, don't ever hesitate to reach out. So we appreciate the partnership.
Thanks, Rick.
All right. Thanks, Clint. Take care.